You're 65. The house is too big. The kids are gone. And downsizing sounds like the smartest financial move you could make. Sell the family home, pocket the difference, and retire comfortably. But here's what nobody tells you. The IRS is waiting with a tax bill that blindsides 60% of retirees. I'm talking $40,000, $50,000, sometimes more. And the worst part, you won't see it coming until it's too late. Let me paint you a picture. You've lived in your home for 30 years. You raised your kids there, celebrated holidays, built memories. But now, it's just you and your spouse rattling around in 4 bedrooms you don't need, climbing stairs that are getting harder each year, and paying property taxes that make you wince every quarter. So you do what seems logical. You sell for $450,000. You buy a nice little condo closer to your grandkids for $250,000. You walk away with $200,000 in cash to boost your retirement savings. The real estate agent congratulates you. Your friends say you made a brilliant move. You feel financially savvy. Then April comes. Your accountant calls. And suddenly you owe the IRS tens of thousands of dollars you never budgeted for. Your stomach drops. That retirement cushion you were counting on, a huge chunk of it is gone before you even got comfortable. The capital gains trap. Here's what happens. The IRS does give you a break on selling your primary residence. If you're single, you can exclude up to $250,000 in capital gains. If you're married, that jumps to $500,000. Sounds generous, right? It is, but there are conditions attached that trip people up every single time. First, you need to have lived in that house as your primary residence for at least 2 of the last 5 years before selling. Most people meet this requirement easily, but here's where it gets tricky. If you moved into a retirement community a year before selling, thinking you'd test it out, you might have just disqualified yourself. Second, if you ever rented out part of your home, took depreciation deductions, or claimed a home office, you're facing depreciation recapture. The IRS wants that money back, and they're not gentle about it. Third, federal taxes are just the beginning. Your state wants their cut too. California, New York, New Jersey, these states have their own capital gains taxes that stack on top of what you owe Uncle Sam. Let me tell you about Linda and Tom from Sacramento. They're both 66 retired teachers, and they thought they had their finances figured out. They bought their house back in 1985 for $120,000. It was a stretch at the time, but they made it work. Over nearly 40 years, they watched their neighborhood transform. Property values skyrocketed. In 2024, they decided to downsize. They sold their home for $680,000. After paying off what was left on their mortgage and covering closing costs, they netted about $640,000. They bought a smaller place for $380,000 and felt fantastic about having an extra $260,000 for retirement. Then tax season arrived. Their capital gain was $560,000, the sale price minus their original purchase price. They were married, so they got the $500,000 exemption. That left $60,000 in taxable gains. The federal long-term capital gains tax rate hit them at 15%. That's $9,000 right there. But California doesn't recognize the federal exclusion the same way. California's tax code treated that $60,000 at their ordinary income tax rate of 9.3%. Another $5,580. Total tax bill. $14,580. Money they hadn't planned for. Money they thought was theirs. Linda told me they had to dip into their savings account to cover it. The same account they'd been building for emergencies. And here's the thing, they got off relatively easy. If Linda and Tom had sold a rental property instead of their primary residence, they'd have gotten 0 exemption. Every single dollar of gain would be taxable. On a $560,000 gain, they'd be looking at $84,000 in federal taxes alone, plus another $52,000 to California. We're talking about $136,000 gone, just like that. Or imagine they'd taken home office deductions for 10 years while working from home. The IRS requires depreciation recapture on that portion of the house. You've saved a few thousand in taxes over the years, but now you're paying it back at a 25% rate. What if you sold too quickly? Say you bought a home, lived there for a year, then had to sell because of a job change or health issue. Your exclusion gets prorated. Instead of $500,000, maybe you only get $250,000. The taxes double. And here's the kicker that catches high earners. If you had a particularly good income year, maybe you took a large IRA distribution or sold some stocks, your capital gains rate can jump from 15% to 20%. Plus, There's an additional 3.8% net investment income tax if your income exceeds certain thresholds. You're suddenly paying 23.8% federal tax on gains you thought would be tax-free. I've seen retirees owe $40,000, $60,000, even $80,000 in taxes on home sales they thought were protected. And because they didn't plan for it, they're forced to make painful decisions. Some have to delay retirement. Others raid their IRAs, which creates even more taxable income and pushes them into higher tax brackets. It's a financial nightmare that could have been avoided. So what do you do? How do you downsize without handing the IRS a check that makes you physically ill? Timing is everything. If you're planning to sell, do it in a year when your income is low. Retire in January. Sell the house in June. Your income for that year will be half of what it normally is, keeping you in lower tax brackets and potentially avoiding that 3.8% tax. Consider a 1031 exchange if you're dealing with investment property. This lets you sell one property and buy another of equal or greater value without paying immediate capital gains taxes. The taxes are deferred until you sell the replacement property. You can keep doing this, rolling gains forward. And if you hold the property until death, your heirs get a step up in basis. The gains disappear entirely. If you've been renting out your home or using it as a vacation property, here's a strategy. Move back in and live there for at least 2 years before selling. This converts it back to your primary residence, and you qualify for that $250,000 or $500,000 exclusion again. Yes, it requires planning ahead, but it can save you tens of thousands. For those with kids, gifting your home can be a powerful estate planning tool. You can gift up to a certain amount per year without triggering gift taxes. If your home's value is close to the exemption amount anyway, gifting it to your children might make sense. They get the property. You avoid capital gains, and if you need to live there, you can arrange a lease agreement. Talk to an estate attorney about this. One, it's complicated, but it works. Another option is an installment sale. Instead of getting all your money at once, you spread the sale over several years. The buyer pays you in installments, and you only pay capital gains taxes on the portion you receive each year. This keeps you in lower tax brackets and spreads the tax burden over time. Plus, you're earning interest on the outstanding balance. It's like being the bank. You can also look at opportunity zone investments. If you invest your capital gains into a qualified opportunity zone fund within 180 days of the sale, you can defer those taxes until 2026 or until you sell the investment, whichever comes first. If you hold the opportunity zone investment for at least 10 years, any gains from that investment are completely tax-free. It's a newer program, but it's legitimate and can be incredibly powerful. The point is this: downsizing can be a brilliant financial move, but only if you understand the tax implications before you list your house. The difference between paying zero in taxes and paying $40,000 often comes down to timing, planning, and knowing the rules. Most real estate agents won't tell you this. They're focused on closing the deal. Your accountant might not bring it up until you're already signing closing papers. And by then, it's too late. So before you make that decision, talk to a tax professional. Not in April when you're filing your return, but 6 months before you even think about putting up that for sale sign. Run the numbers. Understand your gain. Know your exemptions. Factor in state taxes. Look at your income for the year. Because the absolute worst thing you can do is make a major financial decision based on assumptions. You assume the sale is tax-free. You assume the $500,000 exemption covers you. You assume you're in the clear. And then the IRS sends you a bill that turns your retirement dream into a financial scramble. Don't let that be you. Plan ahead, understand the rules, and protect the money you've worked decades to build. Your future self will thank you.